Okay, well, good afternoon, everyone, and thank you very much for joining us today. So we're at that time of year again. It's tax time, and the end of financial year is fast approaching. But before we go breaking out the champagne, we thought we should have a discussion about some of the things that we should be on top of in the lead up to the end of financial year and also in the tax preparation for the 2022 financial year. So joining me here today is Steve Curtin, Senior Business Services Manager here. Sorry, Steve, Quantum Advisory. Glad to have you on board and looking forward to sharing some insights. Just thought would start by running through a bit of a brief agenda. What we wanted to discuss today. So going to run through some of the items from the March budget and the implications that might have on end of financial year tax. We then want to run through some of the things you might want to look at doing prior to June 30. We want to cap off on some of the balance sheet items that are sometimes overlooked. And then Steve's going to take us for a bit of a stroll through the complexities of companies and trusts and the things that need to be discussed there. Also some of the timing of some of the things we're going to be discussing today, and then we'll wrap up. Now, do want to encourage questions. At the end, there will be a bit of a Q&A session. So if you've got any questions, please put them in the chat, and we'll get to as many as we can. And yeah, strap in, and we'll look forward to kicking off.
One question we often get is, yes, there will be a copy of the recording available after the session. So
yeah, 100%.
So you can watch that to your heart's content.
Yeah, so if you've got nothing else to do on the weekend and you want to stream it all weekend, feel free to go ahead. Okay, so looking at the March budget. So a couple of things that were approved that we thought we'd just touch on quickly. So the fuel excise cut from 44.2 cents down to 22.1 cents. That came into play in March and will be running through until September. We'll finish up then, and then we're not entirely sure what's going to happen then. That was obviously a relief measure for fuel prices. We'll wait and see what happens then, whether that's extended or not. The reduction in GDP uplift factor on PAYG and GST tax instalments from 10% to 2%. That was sort of a bit of a hangover from the COVID stimulus measures. We'll wait and see what happens there. The 250 cost of living payment, that's been approved, and the 1,500 low and middle income offset will cease at the end of this financial year. Now, they've been trying to phase that out for a while, but at the end of this financial year, we'll see the end of that. So that may negatively impact some moving forward. And also COVID-19 tests, so they're deductible for employees for work purposes, and they're not subject to FBT for employers. So just a bit of a note to make sure that's being recorded correctly internally. Now, there's a couple of things still up in the air from the March 2022 budget that we'll wait and see whether these eventuate or not, but they're still yet to pass the House. So there's 120% deduction for skills and training, and also the technology investment boost. We'll wait and see whether that actually eventuates now. And as we're all possibly aware, the instant asset write-off will be finishing up at June 2023, and then who knows what happens then. It's up for debate, obviously, what's going to happen there. But as we know it, we've got no reason to think that's going to extend past June 2023. And the proposed expansion of the patent box system is still yet to pass the House. So that was a cool little incentive that if you held certain patents in Australia, that your corporate tax rate would be capped at 17%. If you're in those industries, you've probably heard about it from industry bodies and the like. There's no saying whether that will eventuate or not, but we'll be keeping our ear to the ground, and no doubt you'll probably hear a bit more noise if you're in those industries. And with that, I'm going to hand you over to Steve, who's going to take you through some items that we need to discuss pre-June 30. Take it away, Steve.
So obviously a good time of year just to have a look at some pre-30 June actions and strategies that we might be able to take in the lead up to end of financial year. So first up, one thing I always like to point out is just whether you've got an actual saving or just a timing when it comes to tax deductions. So don't spend $1 just to save some tax. So at the most, you'll get a tax deduction of 47 cents if you're an individual on the highest marginal rate. If you're a company, it's only 25 cents that you're saving. So you're better off to keep that 75 cents in your pocket if you don't need to spend money on something. So always think of the commerciality and the business case behind it. So you don't just go and spend money for the sake of getting a tax deduction. Bringing forward a deduction can save tax this year. It's only a timing resulting in some more tax next year. So essentially, you know, to an extent, you're robbing Peter to pay Paul. And as there's no change in the tax rates between 2022 and 2023, there is no real saving. It is just the timing of bringing that deduction forward, which, you know, there might be an argument for, but just keep in mind that if you claim it this year, you can't claim it next year. So therefore, it's often more important to match expenses to revenue by accounting for work in progress, prepayments, and income in advance and the like. So instant asset write-off, obviously being a hot topic. So, you know, those would be familiar that when it first came in, it was a $20,000 threshold, then went to 30,000, then 150,000, and then currently it's unlimited. And as John said, that still applies through until 30 June 2023. And so it's called the temporary full expensing measures at the moment. And so most of our clients would be eligible given the $5 billion turnover threshold. There's also, just to note, that second-hand assets are eligible if your turnover is under 50 million. So as we said there, so that came into the current rules came in October 2020, and they run through until 30 June 23. And then at this stage, we've got no clue as to what's going to happen after that. So deduction can only be claimed once the item is installed and ready for use. So not just when the deposit's paid. So if you've got, you know, green plans to go out and buy a new car by the end of before 30 June, chances are you're not going to have it installed ready for use, you know, with the availability of stock. So that deduction is probably going to fall into next financial year, but it's still going to be eligible for that temporary full expensing in the 2023 year as well. It's also important to note that it only applies to depreciable assets, so that's items of plant equipment, vehicles and the like, and not capital works, which are things like building improvements. They're still under their own separate rules. Just included a table from the ATO website there, and as you can see, it's a bit complicated as far as different rules apply depending on what level of turnover you've got there. So just a few things to note. You know, whether you can opt in or opt out of the temporary full expensing depends on whether you're already in a small business entity pool. So if you had turnover less than 10 million and you're using the accelerated depreciation rates, then you would have had to have written off the balance of that pool as at 30 June 21 under the temporary full expensing. Whereas if you're in you know, some higher turnover brackets, then you've got the potential to opt out if you weren't under those SBE rules. And then, as we sort of just mentioned before, there's some different rules around second-hand assets when you're in that sort of above 50 million category. So just always, you know, things to consider, and we can look at those in tax planning and preparing, you know, financial statements as well. So just sort of touch base with us to help work through those for your specific circumstances. And that's just one other point to note, that, you know, anything that we talk about today is just general advice. And so, you know, please contact us to see how that applies in your specific circumstances. So then small business entity depreciation pools we're just touching on. So that's the SBE, it's called, for depreciation. So as I said, they should have written off the balance of that pool in 21, leaving no depreciation to claim for 2022 in relation to your existing assets. Only any new assets that have been purchased in the 2022 year would give you a temporary full expensing or depreciation deduction. So what that means is that the proceeds of sales or trade-ins will often be fully taxable if you've claimed the entire balance of a pool or written it off completely in prior year. If you when you go to sell it, it's going to be fully taxable, those proceeds. And important to note that depreciation of luxury cars is limited to 60,733. However, if you were to sell one, the sale price is fully accessible. So just important to note, if you're changing over a vehicle, if you're looking to buy a new luxury car and trade in the old one, so you might be trading in the old one for 80,000, you're actually going to have more income than you are going to get deduction, because the full amount of the 80,000 would be a taxable sale. However, you're only going to get depreciation claim up to that 60,000 figure on the new vehicle. So just a bit of an example on some capital expenditure tax savings. So a manufacturing business decides to replace the machines prior to 30 June 2022 at a cost of 100 grand. And so the new machine should speed up production by 30%, enabling a higher production capability and some shorter lead times. So this is expected to generate an additional 200 grand gross profit next financial year. And tax savings are 25 grand, being the 25% of the 100 that you're claiming. So within 6 months, the new machines have paid for themselves, with any additional GP going straight to the bottom line thereafter. So moving on now to have a bit of a look at superannuation. So there's a few areas to cover off on. We're looking at compulsory obligations up front, which is the superannuation guarantee, or the 10% that's paid on employee wages. So most people would be aware that superannuation is tax deductible when it's paid, not when it's accrued. So therefore, it's the date that the funds are received into the super fund account, not when you've paid it, that becomes relevant for determining, what financial year they fall into as far as tax deductions are concerned. So we would suggest to pay them by the 24th of June at the latest. However, if you're paying through a superannuation clearinghouse or other provider, just check with them as far as when they say that they need to get the contributions made. So just important, if you're trying to claim a tax deduction in this financial year, either as an employer or a member contribution, that just to make sure that you're aware of that cut-off date. You can't do it at 11:59 p.m. on the 30th of June and hope it's going to get in. Also, just to note that harsh penalties apply if superannuation is paid late, even if it's paid in full. So that just means that you've still got the 28 days after the end of quarter to ensure that your superannuation contributions are paid. So you'll still get the deduction in next financial year if you paid in July. But just to keep that in mind, that it does catch people out, and it can be pretty expensive. So just having a look at a bit of an example for superannuation payable. So superannuation payable to employees for the June 2020 quarter is 20,000. So instead of waiting until the due date of 28th of July, the business pays the super before 30 June. And that means that as a result, 20 grand is now tax deductible in the current financial year, which based on a tax rate of 25% has enabled them to bring forward a tax saving of $5,000 into this financial year. So moving on, some additional contributions. So the 2022 concessional contributions cap for super is 27,500. So that's up from 25 grand in previous years. This includes any form of super contribution for which a tax deduction is claimed. So that includes your 10% superannuation guarantee on wages, any salary sacrificed contributions, or any member personal contributions that you're claiming a tax deduction for. So just you've got to keep that in mind when you're working out if you might be looking to make a personal contribution. You've just got to factor in any salary sacrifice or employer superannuation guarantee contributions as well. So the taxpayer will claim a deduction at their marginal rate and then pay 15% tax in the super fund. Just to be aware that that Division 293 tax is also charged at 15% of contributions where an individual's taxable income is greater than 250,000. However, an individual on that level of income would be sort of paying tax at a marginal rate of 47%. So even though they're going to be paying 30% tax within the super fund, there's still a 17% tax saving to be had by making those contributions. So it can still be worthwhile. So just having a look at an example for concessional contribution. So Barry's 55 and he's got taxable income of 180 grand, consisting of 120 grand worth of wages and a trust distribution of 60,000. So as his taxable income is 180 grand, his marginal rate is the top rate of 47%. So Barry's going to receive 12 grand of superannuation guarantee, being 10% of his 120 grand wages. But also decides to maximise his concessional contributions up to the $27,500 cap. So he makes a personal concessional contribution of 15.5 grand, which results in a personal tax saving of 7,285. Meanwhile, his super fund pays 15% tax on that 15.5 grand contribution going in, which is 2,325. But his net tax saving is just under 5 grand, being the difference between the tax saving on his personal and the tax that he pays in the super fund. Mr. Smith, on the other hand, has a lower income and only pays an average rate of 34.5%. However, as he's over 65 years of age, he has started taking a pension from his super fund. He doesn't have any surplus cash, but he's interested in saving some tax. He decides to pay 25 grand into super, then withdraw those funds from his superannuation pension and reinvest the funds back into the business so that the impact on his cash flow is neutral. So basically puts it in and then takes it back out again. But he can have a tax saving there at 25 grand at the 34.5% rate of tax that he's paying is a saving of 8,600. Less the tax in the super fund of 3,750, he's still saving about 4,800. So the superannuation carry forward rules, so they came in a couple of years ago from the 2019 year they apply. So taxpayers can also carry forward unused concessional superannuation contributions caps from that 2019 year, provided your total super balance as at 30 June of the previous year is less than 500,000. So we can check your unused caps and your total super balance through our ATO portal. And what that can mean is that you can actually put in more than the 27.5 grand cap in the current year if you've got some unused cap available from previous years. So we'll just have a look at an example here. So Lydia has a total super balance of 200 grand as at 30 June 21. So she's under the 500,000. And she also has the following concessional contributions history. So each year she's made 15 grand of concessional contributions. There was a cap of 25 grand. So she's got 10 grand unused from each of those 3 years that she can carry forward. So then she can make a maximum concessional contribution for 2022 year of 57,500, which is the 27.5 grand cap for the current year, plus the 30,000 that she can carry forward from previous years. So she can get a pretty hefty deduction in this financial year to sort of catch up on those unused caps from previous years. Over to you, John, balance sheet review.
Okay, thanks for that, Steve. So I think one of the next things we just wanted to touch on briefly was a review of the balance sheet. It's one thing we encourage all our clients to do, and any business in our network, is to go through the balance sheet in detail in the lead up to 30 June and take a look at which accounts on the balance sheet may potentially impact tax deductibility and which could impact the P&L. And a couple we just wanted to bring to your attention today. So the first one being prepayments. So for small businesses, prepayments of expenses are tax deductible in the year that they are paid if the payment is incurred for an eligible service period not exceeding 12 months. So effectively what we're saying there is that if you're prepaying expenses, it could be, it could be some marketing costs, it could be insurance or rent or something like that, and you want to prepay 12 months in advance, well, that can be claimed as tax deductible. However, if the expense is exceeding it, is for a time period that's exceeding 12 months, then that can't be claimed. A little warning to issue here, and that is that if you then amortize that expense for accounting purposes and you still want to break that up for the sake of management reporting over 12 months, if you've prepaid the expense and then some of that expense amortized falls into the next financial year, that obviously has to be added back for tax purposes in the financial year following. Next, we just wanted to touch on stock. So as we mentioned on the on the slide there, that it can be valued at the lowest of cost replacement value or net realizable value. Now, obviously, the lower the stock figure is from a tax perspective, the better. And but a couple of things we just wanted to draw attention to you. That is that a full stock take really needs to be done 30 June if you're not doing that already. And a few things to be wary of. That's anything that's consumable or has a shelf life, making sure that's correctly accounted for. Anything that's obsolete, making sure that's been accounted for as well. And the net realizable value is an interesting one as well, because what you intended to get for the product may not necessarily be the value now. So it's good to take all these things into consideration. And just, I guess the main point we want to make here is don't have an overly inflated stock figure. That's bad for a couple of reasons. One is obviously it's bad from a tax perspective and will cost you more in tax. But secondly, just from a business management perspective, you just don't want to be showing the situation as better than it is when the reality is something different. So just a couple of words of warning there. And we've got a bit of an example of a stock take here. So ABC Proprietary Limited conducts a comprehensive stock take at 30 June 2022 and notes they have 50,000 of stock that is more than 12 months old and has a net realizable value of 50% of its cost, and 20% of stock that's obsolete and has no value at all. The company can claim a tax deduction of 45K, being half the 50 and the 20, saving the company tax of 11,250. So I guess this is a sort of once a year opportunity to really clean things up and take a look at the inventory holdings in a fair bit of detail. Next, we have the debtors listing. So checking aged debtors listing for any potential bad debts. This goes with the very obvious caution that you're better off getting the full amount than the tax deduction. So you'd be wanting to make sure you've exhausted every avenue there of seeing if those debts are recoverable. If not, making the call and writing those debts off as a bad debt and getting the tax deduction for it. And then the obvious one there as well, making sure you're picking up the GST claimable there. So an example of a bad debt there is ABC Proprietary Limited conducts a review of its debtors and notes there's an invoice for 11,000 they won't be able to recover. The directors decide to write it off as a bad debt. The company will get a refund of the $1,000 of GST they've paid in the previous quarter, and they'll save tax there of 2.5K. And just another note there that's important to note: the provision for bad debts is not deductible until it's actually written off. So the only thing claimed under bad debts are debts that you've given up any hope of recovering and decide to write off completely. That said, if you're very confident that you're not going to get paid for it, you may as well at least get the tax deduction, and the GST back, so don't just let it sit on the debtors ledger indefinitely. And the final thing for this section is we just want to touch on fixed assets. So going through the asset ledger and making sure that everything on there should be on there. So review any assets that aren't pooled, see if any of them should be written off due to either being obsolete or having already been scrapped. If there is anything on there that has some value that shouldn't be there, you may as well be writing that off. But a note there that does not apply to pooled assets. And if you're slightly confused about that terminology of an asset ledger versus pooled assets, then perhaps reach out to your accountant and run through that in a bit more detail. And with that, Steve, do you want to take us through the lowdown on companies?
Yeah, sure. Just thought we'd have a look at a few things that are relevant to companies and also trusts in this section. So just in relation to Division 7A loans, so they're loans that often arise from drawings that have been taken out of the company. So they're unsecured loans to directors, shareholders or associates, and they must be repaid over 7 years with interest, and then either with a physical repayment or offset with dividends. So just something to keep in mind with tax planning that we can assist you with. If there's some loans there that need some repayments covered by dividends, we'll just need to calculate that and then factor that into the tax planning, and then the flow on impact to the relevant shareholders, down the line. So yeah, as said there, we can assist and with the calculation and advising the minimum repayments when we're doing that tax planning process. Another thing that sort of came in a couple of years ago was the loss carryback rules. So that gives you the opportunity to offset current year losses against prior year profits and get a refund of the income tax that had been previously paid. So this may affect the franking account. So you just need to check the franking account balance before applying the offset. And then that will have, again, a flow-on effect with what franked dividends are able to be paid. So just with an example here, so ABC Proprietary Limited made a profit of 300 grand in the 2019 year and paid income tax of 82,500. So then in 2022, the company incurs a loss of 100,000, and that might be because they've got some temporary full expensing that they're claiming this year. So you can claim a loss carryback offset of 25,000. Which is calculated as being the 100,000 loss times 25% company tax rate, and it gets a cash refund of that. And so, as we said, this will also reduce the balance of the franking account and by 25,000, which can then have flow-on effects to the ability to pay franked dividends. So, yeah, again, talk to your accountant if you're in this situation and see what might be the best approach for you. So then just moving on to trusts. So discretionary trust is something we need to always consider in the lead up to 30 June. So as most would be aware, a trustee resolution is required to determine the distribution of income before 30 June each year. If a trustee doesn't do that, then it'll be assessed at the top marginal rate itself. So that's why we always need to document in writing and have signed who the trustee is going to distribute to, and there's many ways that you can determine that. You can specify particular amounts. You can do it on a percentage basis, just as long as there's some way that you can easily determine before 30 June that you can then flow through to once the actual result is known at the end of the year. So important to review the trust deed, as that determines who can receive the income. So depending on what the deed says, beneficiaries may include family members, employees or companies. Also, one thing to be aware as to whether there's a family trust election in place, which is a special tax mechanism that has some benefits for things like flow on of franking credits out of a trust within a family group, but it does also mean that then you can't go and make distributions outside of that family group. So just to be aware of those things, and again can look at and determine when you're doing a tax planning process. One other little thing is that minors can also receive distributions of up to a massive $416 tax free. So if you've got a few kids, it might be worthwhile. That's right. So just an example on some trust distributions. So Smith Family Trust makes a profit of 400 grand during the 2022 financial year. Without a trustee resolution, the trust would pay tax at 45%, being the top margin rate minus Medicare levy. So the trustee made a resolution before 30 June to distribute income to the following people. So first 90,000 to their adult daughter. Next, 416,000 to their minor son, 10 grand to a local charitable trust, and then the balance split equally between Mr. and Mrs. Smith. So when we do the final resolution, that would work out to be that 149,792 each. But at the point before 30 June, you're not necessarily going to know that it's exactly 400,000 in profit. So that's why if we do that wording to sort of a bit of a catch-all to split the balance equally at the end, then that makes it effective trustee resolution. And then each beneficiary will then pay the tax at their own applicable tax rate. Just one question that we get a lot is in relation to tax timing, specifically in relation to pay-as-you-go instalments. So just thought it'd be good to run through just a bit of an example as to how that works. So just using a company here. So you may be aware that an entity's pay-as-you-go instalments are calculated by the ATO based on the last year's lodged tax return. So for the 2021 financial year we're looking at here, SMK Proprietary Limited had tax payable of 100 grand from the 2020 financial year. So the ATO then assumes that it will have tax payable of 100 grand for the 2021 year. It therefore levies the 2021 pay-as-you-go instalments of $25,000 per quarter. So in reality, there's a bit of a CPI uplift that we sort of touched on a little bit earlier before, so it might be slightly more than the 25 grand per quarter, but just for the purposes of our example here, we'll just run with that neat round number. So then in 2021, due to a combination of COVID, claiming additional deductions for temporary full expensing and writing off the balance of its SBE depreciation pool, the company's 2021 tax payable is only 20 grand, which then results in a tax refund of 80,000. So they paid 100 grand in installments. Actual tax payable is only 20 grand, so you get a refund of the 80. And then what happens there is that this will then in turn reduce the 2022 pay-as-you-go instalments to 5,000 per quarter, based on the 20,000 tax payable from the 2021 company tax return that was lodged. So then we move over into the 2022 financial year. And so here SMK Proprietary Limited has recovered from COVID, but has no deductions for depreciation or temporary full expensing, because it hasn't bought any new assets. It bought all it needed to in the previous year, and it wrote off all the balance of its SBE pool. So it's got not as much in the way of deductions. Therefore, it has tax payable of 150 grand. But as we saw in the previous slide, unfortunately, due to the low tax result from 2021, it's only paid instalments towards the 2022 tax liability of 5,000 per quarter. So what will happen is when it lodges its 2022 company tax return, it's going to have 130 grand of tax payable, which is going to be due between December 22 and May 23, depending on the company's lodgement status. So you can see that, yeah, that's how it can sort of swing around a fair bit between years, just by the ATO re-triggering instalments based on the last year's tax return, which will not always necessarily match up with the next year, especially in the landscape we've got with these large deductions for temporary full expensing. So by preparing a tax plan, we can help to understand, plan and prepare for future tax payments.
That's good, Steve. Well, we're going to wrap up very shortly, and there's some absolutely brilliant questions trickling through, so please stick around for those. Before we get there, we just wanted to run through a couple of reminders, just based on quite a few questions we're getting coming through at the moment. So the superannuation guarantee rate will increase from 10 to 10.5 on 1 July 2022. Most using a payroll provider or payroll software that'll update automatically, but just making sure we're across that. Single touch payroll finalisation is due by the 14th of July 2022, so maybe make a note in the calendar for that. Also, taxable payments annual report, the TPAR, is due the 28th of August 2022. And just another thing we just wanted to touch on quickly was, for capital gains tax purposes, it's a contract date that determines which year it is taxed in, not the settlement date. This is coming up a bit, and particularly with the shift in the property market over the last couple of years, there's people out there with a lot of money shifting around from an asset perspective. So just to bear that in mind, that it's the contract date, not the settlement date, particularly when there's things such as delayed settlements, perhaps land registering, things like that. And you just want to bear that in mind, so that where possible you have access to any CGT concessions that are available. But with that, we'll dive into some questions, and there's some good ones, and I like the first one. It's a little bit politically motivated, Steve, but do you think the Labor government will extend the instant asset write-off beyond 30 June 2023? What are your thoughts, Steve? Yeah,
I mean, we're getting a lot of questions about this. As we mentioned at the top, all we know at the moment is that the temporary full expensing measures, as they are, will cease 30 June 2023. Beyond that, it's anyone's guess as to what might happen. As I mentioned, previously they had different thresholds, 20,000, 30,000, 150. Maybe they scale that back to one of those thresholds. Maybe it goes back to the $1,000 if nothing else comes in. But certainly be something to stay tuned for some further announcements towards the budget next year.
Absolutely. Do you think it'd be a bit of a hard sell job for them to remove it completely? As in,
Yeah, I think so. It's certainly something we've all got used to over the last few years, and that's what they were sort of doing. It was one of those things that they were announcing 12 months at a time, and sort of just re-announcing what the next one would be each year to create a bit of stimulus still in the lead up to 30 June. This has been a good, as I said, from October 2020 was when it came in, so it's been a good run of sort of certainty. But yeah, it'd be interesting to see what happens. This roughly this time next year as to what happens.
And I guess the other thing we've got to consider at the moment too is just the wait time with so many assets, motor vehicles and the like. Some of the wait time is getting out towards 12 months, so we can only kind of guarantee till 30 June 2023, and beyond that we're sort of guessing.
Yeah, that's right. Depends on how good your crystal ball is. That's right.
Okay, another very good question. Does instant asset write-off apply to machinery delivered but not yet commissioned before 30 June 2022? This is a really good one, Steve, because this one just came up very recently with a client where they bought quite a substantial piece of equipment that was literally sitting in their factory wrapped in shrink wrap. But the guys wanting to there was an overseas supplier and they were going to fly some people out because it was a fairly substantial bit of gear to actually set the whole thing up and get it running and functional for them. Due to COVID lockdown and everything, they couldn't. And when 30 June 2021 ticked around, the thing was still just sitting there wrapped in plastic. So what are your thoughts there?
Yeah, the ATO rules, the wording is it's got to be installed and ready for use. So in that case, yeah, if it's not installed and ready for use by 30 June, you can't claim the deduction in that year. So same applies, yeah, whether it's, deposit paid or you might have the invoice, it does have to be installed ready for use. And the ATO is pretty sophisticated these days, with data matching, especially in relation to vehicle registrations and things. If it's not registered, then you're obviously not able to be driving it around. And in the example there, if it's only landed in the warehouse on the 29th, it'd be pretty hard to say it's installed ready for use by 30 June. So again, where we are now, we're not losing that deduction. We can still get it, the full amount, but it'll just fall in the 2023 financial year in this instance.
Even the ATO being able to data match things such as bank transactions, PPSR, unless you've got a pretty solid case to say it was installed and ready for use, it's probably skating on thin ice.
Yeah, definitely.
Okay, another good one. Can you see the corporate tax rate going back up?
Yeah, not anytime soon. I think it's taken 7 years to get from 30% down to the 25% we finally arrived at for this financial year. So it was 26% for companies last year, 25% this year. I reckon they'll, probably sit on that for a little bit. Just to create a bit of certainty, if nothing else. That'd be my opinion. But
yeah, once again, it'll be a very difficult sell job to try and shift it.
Yeah, that's right. Yeah, these things, they always have a political aspect. So sometimes you don't want to do something that's too unpopular.
Okay, so another good one. What happens if a bad debt written off actually ends up paying? Firstly, congratulations.
Yeah, that's right. That's right. Yeah, happy days. As you said before, you're better off to actually receive the funds rather than the tax deduction. So bad debt. If you've written it off because it's been outstanding for more than 12 months and you didn't think you were going to recover it, you claim the deduction in the year that you wrote it off. If then you manage to actually collect on it in the next financial year, then that just becomes income in that next financial year. So you'll still claim the deduction when you wrote it off, and then it becomes income in the year that it actually comes good. So you don't need to go and restate the prior year. Yep. And the other thing is you might not receive the full. You might get 50% of that debt in the next year. So that's you're only bringing into account the amount of income that you actually receive.
Yep. Yeah, so no need to amend anything or.
That's right. Yeah, that'd be a bit of a nightmare.
Okay, you sort of touched on this one earlier, but it is a very important one. So I'll go back there if you don't mind. That is, how do you word a trustee resolution if you're uncertain of what the final result will be? So, if the profit figure's up in the air, there's a lot of tax adjustments which we've been discussing. What's your advice there? Yeah,
so trustee resolution should always just be worded sort of open enough to, make it flexible for, changes in the, we obviously do a tax plan and we work out the estimated profit, but it's not going to be, to the cent what the actual profit ends up being, when the year ends at 30 June. But it also needs to be specific enough to be an effective determination. So so there's multiple ways of doing it, and you can do it on your percentage basis, or you can allocate specific amounts and then do the balance to somebody or balance in percentage. So just as long as I said, you refer to the deed, it's distributed in accordance with what the deed allows you to do, and you can quite easily do that determination before 30 June and say, yep, I've made that determination, and then it applies once you've actually worked out what the total profit or taxable income is to distribute once you know that upon completion of the financial statements.
Yeah, that's good. That makes it very clear. And another very good one here. So how does the R&D tax offset affect the franking account? This is one we've discussed quite a bit.
Yeah, that's right. I mean, the R&D tax offset, for those that are aware, is a cash tax refund that comes back is a reduction in the tax that you paid. So a bit similar to like what we were talking about before, you can actually erode with the loss carryback. You can actually erode your franking account balance. So you get the benefit of some cash come back, but you're going to reduce the amount of franked dividends that you can pay out from your franking account. So again, just consider that depending on your circumstances, and you might be getting some cash back in the company, but then you might be transferring more of a tax problem through to the shareholders if you don't have any franking credits available to pass through. So
I guess you're really only left with the option then moving forward of either upping your instalments to the ATO to build that franking credit back up, or you're left, as you say, you're left with the problem of having to pay unfranked dividends or something that just doesn't have that tax credit.
Yeah, that's
another way of getting the profit out of the company.
That's right. Yeah, you'll end up paying tax on it somewhere along the line. So
the other, I guess the other thing we're noticing with the R&D tax offset a little bit is quite often companies are engaging consultant, and all these offsets really, but quite often they'll engage a consultant to assist them with the preparation of that and make sure they're ticking all the boxes, which is great. But they're quite often working to their deadlines, which means that we can have quite an accurate picture of where the tax is sitting, provided them getting the financial documentation for the R&D claim. So it's probably worth just mentioning that as well, because we might come up with a plan that that best suits a client in terms of paying dividends and paying future dividends, but then all of a sudden, we've got to factor in that there's this large, this large refund that's ultimately going to affect the franking credit balance. So.
Yeah, that's right. As I said, the timing with that, it often comes about, you've prepared the tax return, and then the R&D claim's prepared afterwards, and you end up going back and doing an amendment to include that. So as I said, that can mess up other plans that might already be in place.
That's good, Steve. Well, I think that pretty well brings us to the end. There are a couple of questions here that I think, just in the interest of time, we might get back to in due course. But we'd love to thank everybody for joining us yet again. Hope you've learned something. And of course, once again, if there's ever any questions, feel free to give us a call or flick us an email. We're always just a call or an email away. And we'd love to help you out. But
most clients we're in the middle of tax planning process at the moment. We've been meeting with a few. We've got a few more meetings to do over the next couple of weeks. But if you've got any other questions, reach out.
Awesome. Thank you very much.
Good day.